Hello, and welcome to Money Mystery No More. Money is tight, watching every dollar spent, buying what is necessary, nothing more. Today, milk costs more, today bread is up a nickel, coffee went up too, all since yesterday. This inflation hurts, and if you already lean towards minimalism or live frugally, you'll find this conversation interesting as we talk about how inflation nixes a minimalist method. To really benefit and get the most out of this video, you will love the real-life lessons and information about inflation, how it nixes a minimalist method, and how to hedge against it by keeping it simple. It's awesome, and remember, hit that subscribe button to keep getting the latest and greatest information. Okay, let's remove the mystery. Remember when buying a bag of chips and a can of soda was about $1? Today it's likely double that, around $2. Maybe that's not your thing, but a cup of joe is. Well, it's the same story. Stop in at your local Java favorite and spend about $1.50 for a regular drip. Oh wait, that was then, not terribly long ago. Today that same regular drip coffee is weighing in nearly double that, if not more. Your wallet is experiencing inflation. Whether it's 48% more expensive for a soda and chips or 99% more for a cup of coffee, you feel the price increase. Your dollar has lost value, its purchasing power, because today you get less for that dollar than you did yesterday. Inflation is generally described as your purchasing power of money decreasing over time due to the rise in prices. The rate of inflation should be slow over time, but it doesn't have to be. Inflation has no boss, and it can result in a drastic rise in prices on all of our goods and services. It impacts you, your social circle, and indeed the economy as a whole. With inflation's resulting higher prices, you must adjust your spending habits to deal with the higher cost of living. As typically taught early on in junior high and high school, we learn that when demand for goods and services is higher than the supply, prices go up. The same is true if the raw material used to produce goods is limited in some manner. That too will almost always result in higher prices, even if temporarily. Supply and demand dictate the laws of inflation. First, when the supply side is static but the demand increases, prices increase. It's inflation. This is also known as demand pull inflation. It is common for a strong economy to also deliver higher profits and often higher wages. Consumers then spend more on goods and services. The increased demand may lead to inflation, pulling prices up. When the supply side gets reduced or constrained but the demand is static, prices increase. It's inflation. This is also known as cost push inflation. In this scenario, companies have something occur which prevents them from producing enough to keep up with normal demand, so they can increase prices. The increased prices may lead to inflation, pushing prices up. Think about toilet paper during the COVID-19 epidemic. The price doubled in some areas in what seemed just a matter of days. The supply chain struggled to keep goods moving and suppliers struggled to keep producing due to labor challenges. Quite simplified, but the result was drastic inflation in a short period of time as prices skyrocketed. Regardless of the cause, inflation is bad news for consumers. Think about people that are 20 or 30 years older than you. They have lived longer and have more experience with prices on goods and services. You may have heard the grumble about how much a cup of coffee is compared to back when. While commodities are generally impacted harder, let's assume a cup of coffee was $1.22 10 years ago. Today, it is $1.59. That's using the average 10 years inflation data as provided by the U.S. Bureau of Labor Statistics from 2013 to 2023, in which there was 2.7% per year inflation. It may not seem like much, but a single cup of coffee starting off at $1.22 with just 2.7% inflation average per year, after 10 years will cost $1.59, a huge 30% bump. Again, commodities like coffee will likely rise a lot more due to varying factors impacting the production, harvesting, packaging, transportation, and distribution of those delicious beans. Inflation is even worse if you practice being real frugal, like a minimalist. Use of the word minimalism in art suggests the artist's style limits what is used to the least amount of materials and colors. Minimalism may imply a person doesn't get involved and prefers to put forth little action towards a situation. That doesn't make you think of money or finances, but Dictionary.com has a version of minimalism being a lifestyle involving a reduction or simplification of one's material possessions that frees one to lead an existence that is more intentional, purposeful, spiritual, etc. Extreme minimalist living has a person only using or retaining things that are absolutely necessary to survive. Wow, seems like that could be rough. Yet, from a minimalist perspective, this rationale applies to finances and money. may create an opportunity to limit purchases to items that perhaps only add value to their life or are truly needed to survive. Sounds different for sure, but let's see how a minimalist method works along with the damage inflation will do for that lifestyle. One of the main tenets of being a minimalist involves limiting expenses, basically trimming down non-essentials. Some related questions and concepts related to this would be, what subscriptions can be canceled? Start buying groceries in bulk for better pricing. How many credit cards do you have? Consolidate debts and accounts today. Be ready for the rainy day with consistent investing or saving. Are you taking advantage of the free things in life? Get rid of stuff not used in the last 6 months, or even grouping errands logistically to minimize driving. Coupling some of those concepts with budgeting practices is also a minimalist attribute. Money is managed carefully, and one or more budget methods can be implemented. Consider the 50-30-20 rule. 50% of your money is budgeted for your needs, 30% is for your wants, and 20% is reserved for your financial goals. The only difference here is that a minimalist may well consider adjusting the numbers something like 65% needs and 15% wants. In fact, if inflation is spiking, those numbers will certainly adjust as the value of your money drops. Of course, there's also the cash system. With the cash system, you literally pay cash for everything. This simple method is very effective because if you don't have the cash, you don't spend or buy stuff. This is an ideal method for a minimalist. The cash system also plays well with the zero-based budget. Yes, it's what it sounds like. Spend each dollar you earn to zero. By assigning each of your earned dollars to a bill or expense, you end up with $0 at the end. The minimalist lifestyle works well with this budget method too, as expenses are managed tightly, which will help during periods of inflation due to better planning. Inflation does not mean higher prices for only one item or service. Inflation can mean higher prices broadly across one state, an entire country, a single sector, or an industry. Considering the discipline that goes into a minimalist method of living, it's easy to realize why inflation nixes their daily habits. Think about this. You could go to a movie for about $2.89 in 1980. Only 19 years later, that ticket price jumped to $9.16. And just 5 years later, in 2024, an average AMC movie theater ticket was $13.69 for adults, $10.69 for children, and discounted to $12.69 if a senior, student, or military. While that is a whopping 339% inflation over 44 years, even the 5 years from 2019 to 2024 is bad. Apply the inflation formula, current price minus former price, divide it by former price, to get the movie ticket's inflation rate. We quickly see the current price will be nice and use the $12.69 discount rate, less the former price, we're going to use the 2019 rate of $9.16, divide that all by the former price, and our movie ticket price shows a 38.5% increase. Wow, that was only 5 years, folks. Absurd, right? While a person living a minimalist method may find that loss of money value quite frustrating, many economists think a little inflation is okay. They feel it's a sign of a healthy economy because it sort of focuses everyone to spend or invest their money today, now, versus hoarding cash. Time shows hoarding your cash is a losing proposition because inflation eats away value all the time. Nice little conundrum. On one hand, we as a consumer hate it, but on the other hand, economists don't mind a little in hopes of prompting people to spend their cash. Managing the push and pull of inflation in the United States is the job of the Federal Reserve. They appointed a committee that feels a 2% inflation rate is an acceptable target. Inflation is measured through 8 major categories known as the CPI-U, which illustrates the changes in the prices for a representative basket of goods and services by a group representing about 93% of the U.S. population. An overall CPI, which uses over 200 categories, is also reviewed. Arguments aside, that committee can lower interest rates to boost business and consumer spending if needed. However, that means more spending, higher demand, and likely more inflation as prices start to climb. Eventually, because of inflation, the same committee may decide to raise rates to slow down the spending. Strangely, it's a little dance, and one must decide for themselves if inflation is good or bad. Tampering inflation through your individual initiative is a wise move, especially if living like a minimalist. Investing in the broad stock market will help your money grow and is proven over time to beat inflation. Consider listening to my video, Financial Independence Through Stock Market Steadiness. And one thing you'll learn all about is how dividends are a huge win for long-term gains. Investing into bonds is another inflation hedge, which is shown to regularly beat inflation. They do offer lower returns, but that is because they are also less risky. A special class of U.S. Treasury bonds are TIPS, another financial instrument specifically designed with inflation in mind. And then there's gold. No inflation argument involving investment hedging gets away from the gold talk. One big reason is because of a proven 3.6% average return adjusted for inflation between 1968 and 2020. A solid 52-year run is hard to argue with. Conversely, there were a couple bad years in which gold took double-digit hits of 12% and even 28%, wiping out lots of those gains over the 52 years. There is a whole world involving inflation that will make your head spin, but the value of your dollar is eroded over time. If you are practicing minimalism, there are hedges and ways to strengthen your money's future value. Don't sit idle by knowing inflation nixes a minimalist method when it's pretty clear you can do something proactive by keeping it simple. Remember, hit that subscribe button and turn on notifications so you keep getting the latest and greatest information from Money Mystery No More. I'll see you in the next video.